again, thank you so much for being here. And again, I like these Saturday events. Markets are closed. We kind of kick back. What we're going to talk about today are kind of an option strategy guide, when and how to use which strategy for the best results. So this is to hopefully help you from getting over OSC, which I'll explain what that is. So again, thanks for being here. And a little background on myself. I started my trading journey back in the 80s with a company called Coastal Corporation out of Houston. They had big oil refining and marketing, gas and production, stuff like that. So they had a number of refineries, and I was able to get a trading program which they had, and they would actually teach you to trade crude oil and oil products. First sent me down to their refinery at Corpus, Texas. Spent about 3 months down there, kind of learning the ins and outs, how oil comes in from the tankers and the products that it made. And finally got on the trading desk and on the cargo side, really exciting. Sent me out to Singapore for a couple of years, traded product. In the mid 80s, got hired by this company, Trans World Oil. At that time, they were the large. It was Trans World, Fibro, Mark Rich were the three largest oil trading companies. So spent about 17 years there, 15 out of Bermuda, ran the trading desk for 10. And that's where I started trading options back in 1987. We started selling options on Brent North Sea crude oil, and it was pretty exciting. So kind of never looked back. So we're going to talk about options today. So I'm glad you're here, and let me make sure everything's all set up. Let's get started. So the following webinar workshop today is purely for educational purposes. Any stocks mentioned does not constitute advice and should not be construed as a recommendation. So to me, the secret to trading profits really comes down to options. Now, when you look at trading, it's a business of probabilities, and to be a successful trader, controlling your risk is really what's going to win the game for you in the long run. So by knowing and better understanding how to manage and control risk, it's going to make a dramatic and positive difference in your trading performance. And one of the best ways to do this is through the use of options. Now, when we're trading options, they have so many more advantages than just trading outright stocks. But they can be confusing and sometimes debilitating to traders or investors unless you know which strategy to use when, and then how to use it correctly. So based on the market environment and the cycles and things like that. So I kind of call this debilitating trading dysfunction the option strategy confusion. So I guess do you suffer from us? Probably all of us do to some extent. Now, when we look at options, we were going to look at kind of a strategy guide that I've kind of put together here this morning to kind of take you through some really good steps you can use. So, what do you need to do to overcome that OSC? So let's go through the steps here that I outlined. So step one is you need to understand how option pricing works. So you need to do that in order to, maximize your profits and just understand what you're looking for a specific option trade based on option pricing and what that tells you. Now, when we're pricing an option, the really kind of the most important option factor really for you to start to understand, the first thing or concept out of the chute is you understand the concept of time and volatility and the impact that they have on the price of an option. So the first is the kind of what I call the time component. So this is what we call time value. So what is that? When we look at time value, that's what we refer to as the extrinsic value of your option. It's the premium that a rational investor is going to pay over that current exercise value, the intrinsic, based on the potential to increase in value before expiring. Now, the change in the value of your option based on time decay, we can actually measure that using the option Greek called theta. All right, so we can actually look at on our analytics, and we can look at any point in time during the day and kind of see what time decay is doing to the trade. Now, time decay always works against buyers, and it's going to benefit the seller. And so the reason for this is boils down to option theta values. So they're going to be either a positive value or a negative value. So for example, all long stock options, so if you're long a call or if you're long a put, they're going to have a negative theta value. So that indicates that they're going to actually lose value as expiration draws near. So the worst thing that happen is when you buy an option, a call or a put, and the market doesn't move, you're losing value because of that negative, that time decay or theta going against you. Now, the flip side of that is if you're short, options. So if you're short a call, short a put, they're going to have a positive theta value And that's going to then indicate that they're going to gain value as that expiration draws near. So it's a very important, concept to understand how they affect the price of your option. Now, there are many option trading strategies that sell out of the money options also against just buying at the money. So this is done in many options in order to offset that negative theta value. So it offsets the theta value, plus it's going to reduce your capital at risk. So, you're going to have a lower rate of time decay and a lower capital at risk that you're putting out. So that's why I like spread so much. So, when you look at spreads such as a vertical bull call debit spread, that's basically you're buying a call, but then you're selling out of the money a call against it in order to, knock down some of that theta value and also to reduce the risk. So, you've got that call debit spread like that. And so you started out with that long call, that's going to have a negative theta, but by adding that short call, that's going to bring in a little positive theta, also reduce your risk. So that's the beauty of that. Now, then you've got the vertical bear put debit spread. That's, the same thing. If you think the market's going to go down, you're going to be long a put, and then you can add a put to it. That's going to help reduce that theta, also reduce your capital at risk. And then you have a butterfly, which is a combination of two spreads, right? It's a debit spread with a vertical credit spread together, and you can, mix and match and leg in, leg out. And then we have another spread that's really, really helpful. It's what we call the long condor. So this is a combination of a debit spread, could be a call debit spread or a put debit spread, and then you're selling another spread against it to reduce that theta and reduce your risk. So these are some of the different types of option spreads that you can utilize. Now, the next thing we want to understand is the volatility price component. So that's, referenced by what we call the implied volatility. So it's expressed as a percentage of your stock's price, indicating a 1 standard deviation move over the duration of your option cycle or which option series you're using. Now, in theoretically, a stock then should end up with a 1 standard deviation of its original price 68.2% of the time during the life of its option cycle. So this kind of theoretical probability or forecast of your security price range should be part of your process that you use for selecting the correct or highest probability price targets for your trades that are taken. So this price component volatility is super important from that standpoint. Now, when we then price out the option, it comes down to these components. So you're going to be, taking your time value times the implied volatility times the underlying value of your security you're trading. So once you know these variables, then you're going to be ready to price out that option, know the option premium, and understand and then select the best option strategy. So here's just a good table to illustrate how these two components could affect price. So here's time value times the implied volatility in this column times the intrinsic value. That's the value of your security. That gives you your option price. Now we're going to leave this at a constant, so it doesn't affect price. So you're just going to see here, when you come in your first, like a weekly option, you have a new series that starts on a Thursday. So on that first day, you've got 100% time. So I just plugged in a number here, implied volatility of 300. So you can see 1 times 300 left the security price constant at, not moving. And so the price of your option would be $300. Now, the big thing here to notice is that, after Friday, Saturday, Sunday, Monday, you come back in after the weekend and say on a Monday, that time value component is cut in half, right? So that's cut in half. And then even if the implied volatility component spiked up to 800, it barely pushes the price of your option up. It's only up 400. You started out here at 300, 400, and think then if implied volatility, say, collapsed and was only trading at 200, then the price of your option would only be $100. So the main thing to understand and take away from this is that at the end of your option series, when it's over, your time decay component is going to be at 0, and also that implied volatility component is going to be at 0. So that's why selling options, selling spreads can really help to offset that, time value or time decay, and also, take advantage of high implied volatility, and also lower your capital at risk that you're trading. So those two components go to 0, and that's where we can benefit from a sell side component or just selling options outright. All right, so really important to understand that concept of time and volatility. Now, the step 2 is in trading time. So again, we can actually trade time by selling time to take advantage of that option time decay or theta. So when we sell options, we are again, in essence, selling time and volatility. All right, so when you short a call or short a put, you are selling time and volatility. The other thing that kind of really helps to understand options is think of them kind of like a coupon. You know, you have an option with a certain series, maybe it has like 6 days left or 30 days left. It's kind of like a coupon. Then you know exactly by the expiration date when it needs to be redeemed. All right, so that's another way to kind of think of your options. So when we look at time decay, you can see in this graph how it really tails off. So this is 30 days out from day zero expiration. So now when you start out, you know, further out in time, let's say 120 or 90 days out, your theta decay is going to be very small. You know, it's very, very flat. Now, then once you start moving closer to your expiration series of that option, you can see it starts to tail off. And then on 30 days out, it really starts to really get extreme, right? So that's where you can take advantage of those weekly options that start to really accelerate to the downside as far as the time decay. All right, so that's a graph to kind of illustrate how that really starts to fall off. Now, step 3 then is trading the probabilities. This is what we call, or I call, the market maker secret. It's what they don't really want you to know. You know, they want to try to take advantage of you, so you're trading blind, and they're going to try to do that as much as they can. So here's, you know, when we look at that, the option markets, the markets use mathematical market probability statistics for pricing the movement of an option to its expiration. So by knowing the probability of your underlying security finishing within a certain price range at expiration, that is a really key step for then determining then what options to buy or sell and what option strategy to use. Now, this statistical forecast then, what it does, it forecasts how likely it is that an option will fall within a certain option series price range up or down by its expiration. So, you know, when we look at different, you know, like for example, here's AMD, you can see all the different option series that it has. So you can see here's your 15 November, that's next Friday, 6 days. Then you've got the 22 November, 13, then you go way out here and you can go to Leap. So these are all your different, you know, series that you're working with, and those things will tell you important information based on the time expiration, its implied volatility, and that time decay component. All right, so when we look at the forecast, we use this to kind of forecast the movement where it could go based on these components, implied volatility and time. So the forecast then is what we refer to as the implied move or the expected move of your stock or security. So basically what this is, it's just an estimate of a 1 standard deviation move of your underlying, you know, stock or security by its expiration. So it gives us kind of a statistical measurement that we can start with and use. All right, it's theoretical, but it's super helpful. All right, so for example, if you were to sell an out of money option 1 standard deviation out, you're basically starting out with a theoretical 84% chance of winning, okay? So the way this works is, like, for example, if you were to sell this 520 strike right here, this strike has a 16 delta, okay? So it's when you look at 1 standard deviation, you can see here from 480 to 520, this is the expected move, okay? So expected move up is $20 up, expected move down is 20 down, so that range is that 1 standard deviation. So 34.1% of the time it could be below, the other 34 there. So if you were to sell this outside point, that's roughly like a 15.9% chance that'll be greater than 520, so not much. So you're going to have a high probability that that will probably be expire worthless. So this price point right here has, let's say, a 16 delta, okay, right there, right here, basically 15.9. So the way that that is interpreted is that if you have a delta of 1, that's like your equivalent to you owning 100 shares. All right, so that is kind of how delta works. So if you have a delta of 1, so 100, and you were to sell a 16 delta right there, the difference is 84. So the way that this can be looked at is that if you were to sell that 520 strike short, theoretically, there's an 84% probability that price will be below that 520 strike at expiration, or the other way around. If you were to do, sell that 480 put here, there's the 84% chance, or you can look at a 16% chance to get there. All right, so that's a really, really beneficial way to use your options probability. So, I always refer to one standard deviation as kind of the normal range. So in this example, it could go, it's trading at 500. So the normal range then over that, let's say 10 days or 3 days or whatever, is 520 up, 480 down. And so that's normal what it could do. Now, if it's going to go past that, that gets to be extreme. And then your probabilities go way down. See how they tail off? So then your probabilities are lower. So you're taking on risk. If you're selling, if you're buying way out here on that curve, the probability of that being a winning trade gets less and less. So that's why selling sometimes can be a big benefit based on the probabilities. So here's an example of, kind of option delta and probability. So you can see here, this is just an example on Apple. It's trading at 190.15, 28 days to expiration right here, okay? So then we come down here, we look at the at-the-money price here, the 190 strike. You can see it shows you a delta of 50. So basically that's a 50-50 probability. So 50-50, the coin is going to be at 190 or below or 190 above. All right, now when you go further out, so I call it one standard deviation range, okay? So when you go there, okay, so when you go to the upside, the expected move up here is one standard deviation. The expected move down is one standard deviation. I call that just the range. All right, so if this was to be 2 standard deviations, it would be way out here. All right, so I just called this the standard deviation range. Let me get rid of this. Okay, so now you can see if you take that delta and you go way out here, look at that 215 strike, and you come over and look at your delta here, look, it says 0.05. So, that then, if you look at this here, that's probability out of the money, basically, is what that's saying. So you look at the reciprocal, it says 95. So basically you can kind of back into that a little bit, 100, and you've got that delta on that 215 strike at 5. Then you've got that 95% theoretical probability that price will probably, high probability then it's going to be below 215 at expiration, or you could look at that and say there's only a 5% probability that it will get to 215. So this is just a quick way to measure probability. Again, it's theoretical, but it's so helpful for managing trades, setting trades up, and making quick decisions. All right, so step 4 then is selecting the perfect option strategy. Now the other kind of the first step then is then the process. Okay, so you want to look and break down the market. Okay, so what's going on in the market. You want to identify the market cycle. So, these are some of the questions you ask them. You say, okay, do you think the market's going up, down, or sideways, or no idea? Well, let's take a current, example. What do you think? What's going on currently right now? Where's the market cycle? Well, the market cycle is up, right? I mean, that's the real kind of simple part of it. And then I like to use 5 different chart patterns that I look for. So then the second thing I look at within this process is identify the chart pattern. So I'll scan, and I'll come up with, maybe a volatility squeeze or momentum reversals, and then I'll look at those based on these chart patterns that I've identified and kind of defined. And the next thing you've got to look, what is your, time horizon? Okay, what's your duration? What do you think in that trade? Is this going to be something kind of a short term, maybe intraday, or it could swing maybe a week, 2 weeks? Or is it going to be long term? So, what is your specific time frame, trade duration? And that's going to be based on, your trade. You think it's a quick in and out, or do you think this is something that could trend? All right. So this is a really big question you have to make sure to answer before you put the trade on. So this is just kind of a checklist of the process. And then capital at risk. Okay. So what is your, capital account? Some people may have 5,000, 10,000. John may have 100,000, 200, a million, right? So that's going to make a big difference on how you allocate your trading capital and what trades you take. So that's going to be a big part, capital that you put at risk, and that's going to be then based on market conditions. So you want to also then quantify the market. So we're always going to have some kind of uncertainty or risk, but you want to quantify, is it low, is it medium, or is it really high? Right now, things are kind of low risk. I mean, we've got everything checked the box out of the way. The election's out of the way, some of the big earnings are out of the way, big economic numbers are out of the way. So the risk right now that we see is very low. And then the fifth is, what is your objective? Are you want to be an option trader just to make passive income, or to make a return on something that you already have, maybe covered calls? Or is this something you want to just increase your account by taking advantage of the leverage that all options offer? Or are you really in need of some kind of hedging? All right. So these are kind of the steps that I always mention that you should look at, kind of help you make things more mechanical. Okay, the process. Now, the next thing that we want to talk about is the go-to option strategies. So what are the strategies that you can use? So these are the ones that I would probably primarily go to. So these are going to be based on your market cycles, market conditions. And then what we want to know is, okay, we could go long calls or puts. Okay, that's a simple strategy. We could long or short those. We could, one second here. All right, so we could go long or short that. Yeah, James, I'll get back to you on that. Just don't let me forget. Okay, so we could use calls or puts. We could use a vertical debit spread, which is something I really like a lot. Or we could do a vertical credit spread. So we could do debit spreads. We could do credit spreads. We could do a butterfly spread. These are all great strategies, but it's a question of knowing when to use which strategy, right? So that's where it gets confusing. All right, then there's the long condor, another one that we really use a lot to reduce our risk, reduce time decay, based on how it works. And then another huge favorite is the counter diagonal. So these are kind of what I call go-to option strategies, okay? So it kind of covers everything that you could use depending on the market cycle and the condition of the market that you're in. All right, so you need to kind of quantify that. All right, so the first is, long calls or puts. Now these can be used for all, day trades, swing trades, trades from 1 to 10 days. And also you could go out and do longer term. Now, in general, the really easy way to think about it is look at your delta and generally use maybe go long a 50 or 70 delta, something where you're at the money or you're going in the money a little bit more, and that going in the money is going to help reduce beta decay, all right, because your delta is getting bigger, right? So it's like you're equivalent of you're trading more shares, all right? So like if you had a delta of 50, you could equate that you own 50 shares. If you have a delta of 70, you own 70 shares, right? That's how you can think. So then you could do long calls or puts, and then you've got a defined risk to the downside, but unlimited profits to the upside. So if you're super bullish and you like everything, this would be the way to go. Go calls, then you've got unlimited profit upside. Now the next one is your vertical debit spread. So this is where this is one that I like to use a lot because you can use this for your swing trades or longer term trends. Now again, it's defined risk, low capital at risk, and you're going to have a lower time decay. So if you had a long call right here, that's going to have a big negative theta. But by adding just shorting a call against it, that's going to bring in some positive theta, so that's going to reduce the negative theta. Plus, that premium you bring in reduces your cost of your trade. So then you're going to get a bigger return because you're going to have a bigger return on less capital at risk. So these are great. So you're long a call that has more capital out, but then you sell a call, you reduce your capital at risk, you reduce your theta. These are a great spread. And then the opposite is your vertical credit spread. So this is strictly just selling naked, okay? Not naked, but this is selling calls or puts to take advantage of selling time and volatility. So you could have something like a bear call credit spread, where you sold a call, short a call, and long call here, looking for the market to move higher, something like that, or put spread. So, that's what you're looking at. So bear call credit spreads. Now, what I like to do is what I call mix and match. So you might have a debit spread, and then if you want to reduce that risk quickly, I could sell a credit spread against it, either sharing the same short strike, or I could sell further out. And now I've created either a butterfly or a condor, reducing risk, reducing theta. So that's the beauty, mixing and matching these types of spreads. All right, so here's like your vertical call debit spread. You'll see this has what we call a positive risk ratio. So you can see here, this would be like your long call here at this 10-10 strike, okay? And then you sold a call up here, right here at that 10-20. So $10 wide, which would be $1,000. One option contract's equivalent to 100 shares. So that you did one contract, the spread is $1,000 wide. Now, for doing this, you had to pay $300. That was your debit cost. So that's your total risk, though, $300. Now, your potential profit is the difference. So you could make on this trade $700 if it closes at your short strike or above outside that spread. So if you look at that, you're basically, this would be like making a 233% return, right? You could potentially make $700 on your risk of 300. So that's a great return. So you're risking $1 to potentially make 233. So that's what we call positive risk ratio. So that's real clear to see. Now, the opposite of that is going to be if you do a credit spread. Now, so here's the credit spread side of this potential trade, or just separate. So here you're selling a call at that 10-20 strike, let's say right there. And then, so you're not totally naked, right? You're buying a call behind it at 10-30. So $10 wide spread, so $1,000. Okay, so the spread width is 1,000. Now, when you sold this short strike here, 10-20, you brought in a credit of $200. So that is all you'd make. That's your premium received for selling this credit spread. So if you're right and it closes, above or below this 10-30 or your 10-20 that closed below here, you keep that full $200. But look at the risk ratio. So you have 200, but the risk actually is the difference. You're risking $800 to make that 200. So this is your, a negative risk ratio. You're risking 4 to make 1. Now, why, a lot of people looking at this starting out, they're saying, why the hell would I ever do that? Because this is what we call a probability trade. So earlier I showed you, let's say you sold that 16 delta. So you're starting out theoretically out of the money with the, a good, potential, trade to say have an 84% probability to trade to the downside. So that's what these are called, probability trades. So therefore you're not going to get the max reward like you would on a debit spread. You just get that premium. So that's typical of that. Now the next is if you kind of mix and match these spreads together. So then you can create, what I call a unique strategy by, combining a buying and selling of options. So the vertical debit spread with the vertical credit spread. So by doing this, you're reducing your theta even more, plus you're reducing your risk even more. So it's going to give you a very defined risk, going to lower your risk a lot. And this really helps you to take advantage of time decay in that implied volatility crush that both at expiration will go to 0. So this is where you can really take advantage of it. Now, these will always give you a positive theta, so you don't have any negative theta to the trade. So if it just churns, you have enough time, you're not losing money at all. You're going to make money actually from a butterfly from that positive theta. So these are great to use what directional, or you can do non-directional, but typically we always do a directional trade using a butterfly. And then we use this strategy when we feel there's a good confidence level of a certain target point being hit and expiring at that target point at expiration. So we only use this if we think there's a huge magnet or target price here where it could go out. Not going to use it if we think the market is going to break through that area. That would be another strategy. So here's where you need to understand which strategy to use. So this would be targeting a big area up or down, okay? Not for a big breakout type trade. Now, when used correctly, the butterfly of all the different option spreads, this will give you the highest return on your capital risk of any option spread. Also just great for hedging because we can roll into the hedge. We could be long or short and we could add that hedge really quick, reducing capital at risk and theta. All right, so just a great trade strategy. Now, so here's what it would look like. Here's your long call butterfly. So you've got, you know, you can leg into, let's say you did the long call here, you know, and then you're short that call. And if you wanted to later, you could add another credit spread, the call credit spread. Now you have a butterfly, or you could do it the other way around, or you could do it all at once. So it gives you a lot of flexibility. So when you look at this one, you've got, you know, $10 wide spread, right? 10, 10, 10, 20, 10, 20, 10, 30. So $10, what we call balance. So $1,000 wide. And then this was, by doing this butterfly, you had the call debit spread, you added credit spread, knocked the risk down to a maximum of $100. So now you have $100 at risk. You know, you start out maybe with the call debit spread, then you have the credit spread that reduces risk. This thing dropped down to $100. The potential for then is a $900 if it goes out right there at the top of the tent. All right, so that would be like a 900% return. You're risking $1 to make 9. So that's the exciting part, you know, about using options. You know, if you know option spreads and which to use when, this is a really big plus. And then the other one that we do a whole lot of are what we call the long condor. So it's very similar to the butterfly, but what it does, you know, by combining the vertical debit spread with the vertical credit spread, but it does not share the same short strike of the vertical debit spread. So for example, if you had that vertical debit spread, call debit spread here, you know, if you did a butterfly, it's going to share the same short strike of this debit spread. But when we do the condor, this is a great one to use if you're, you know, got a breakout trade, but you think it's going to, you know, have a cap either up or down. So then we'll widen out where we sell that credit spread. So instead of having a really tight spread here, we'll sell a credit spread further out of the money, giving us a bigger profit zone. Okay, really great trade to take advantage of it, turning your negative theta to positive, also reducing risk. So provides a bigger profit zone, positive theta, great for directional swing trades 1 or 2 weeks out. That's kind of the sweet spot. 1 to 2 weeks is the most. Gives you high returns on your capital at risk, and also really great for hedging. All right, so these are two that are really great to kind of mix and match into. So that's what it looks like. And so you can do this. We can do this with calls if we want to, for typically an upside or a downside, we do puts. All right, so that's the condor. So you could do this as a put, you know, put condor, you had a put debit spread. And then you wanted to reduce that theta decay there. So you had another bull put credit spread here. And then you know, look at your different profit zone. We'll see how wide we can do. We do that based on delta and things like that. So it's a really, we do a lot of those because they're perfect for certain market conditions. And then the other one I wanted to cover, this is another really big favorite. This is what we call the calendar diagonal spread, okay? So this is a really favorite. We do a lot of these, and so it's a kind of a medium. It could be even long-term. Now, these can be structured for, you know, using leaps going 2 or 3 years out. Now, so basically what it is a directional option strategy for speculating on trend and then for your hedging, okay? So we can do this, we can do a call calendar diagonal if we're looking for an upside move, or put calendar diagonal for a downside. Now, the thing that makes this so great is it has a vertical kind of component to the spread, okay? So with the long option leg, so you're further out in time, and then you've got the short option leg closer in. So remember, when you're selling an option, what happens, the closer you get to expiration, it really accelerates on time decay. So rather than like a call debit spread where they're both in the same time frame, if we sell short, the short side of this short duration, we're going to get accelerated theta decay. So that's what makes this really a cool trade. All right, so then we get, you know, get paid to wait. So if things are churning and then finally break out, we can hold a trade during this churn and get paid. And then if we're right on our directional assumption to the upside or downside, then it kicks in. So we can do this for upside moves or downside moves. So it takes advantage of that short-term weakness or strength that you think will eventually in time revert and cycle either back up if it's a call based or back down if put. So then this provides you the time to, let the trade kick in. All right. So that's the big plus of this. So, a lot of times you might see the market getting crushed and then it starts to stabilize, go sideways. And this could just churn for quite a while. So by doing the calendar diagonal, we're going to be short a short duration, long further back. We can just, it's like a covered call. We just sell premium every month to offset our long dated call position. So I'll show you an example of how these work. But these are the kind of go-to trade strategies that you need really in your trading toolbox for trading or investing. So let's take a look. So again, this takes advantage of that accelerated time decay characteristic at the front short dated option that's going to decay at a much faster rate than the long backdated. So you're long further out in time, short close in. All right, so just think of it as a kind of a debit spread, but you're going to have different time durations, shorter on the short side versus the long side. Now, plus then if you have what we call any positive implied volatility, where the front end has a higher volatility, you're getting bring in more premium. All right, so these are really cool strategy. And then you've got that additional vertical spread component that's what really adds the directional element for some really great profit. So basically think of if you ever done covered calls, think of a covered call, but instead of owning shares, we're going to own at a fraction of the price the long dated option further out and then sell calls against it. So we're buying options and kind of at a discount. So it's always done for a debit as well. So here's just a kind of an example. So let's say you just did a call debit spread. So, and we're going to do it for next week. Okay, so that's the 15th. So next week's the 15 November series, right? So then if you did this in that series, you'd be long a call and short a call. Now, what we like to do, I love to do, if I'm looking for an upside move, instead of doing this all in the 15 November series, we might decide, well, let's go further out. Let's go maybe to the 29 November if we think there's a good upside potential on, what we're trading, and it could take some time. Let's go further out. So, we could go out to the 29 November and we could buy that for the long dated, and that's going to give us more time for the trade. So that's like you're buying the shares almost, right? So if you buy the 29 November, that's like 20 days out, all right? So we're going to buy that. But instead of doing it all in the same series, we're going to sell this call against it in the 15 November. All right, so see what we've done? So now we've got that component of that diagonal between the spread here. So let's say that call is long at 100, and then you're short here at 105. Okay, so we've got that component, but we're going to be short that call instead of in the same series of this 29 November. We're going to be short that the 15. That's going to really accelerate. And so then if we keep all that premium, it's going to adjust down, amortize down our long dated costs. We can do that over and over and over. And eventually you could amortize down to no cost. So again, just think of a covered call, but instead of buying expensive shares, we're going to buy cheap options. Okay. So then step 5 is, let's go through a few examples to show you kind of these go-to trades. So first off, these are the ones that I go to. I like to do, maybe we just do a vertical debit spread. Maybe we do a butterfly. It all going to depend on the market cycle and the market environment. Okay, so that's part of the process. Or maybe the market process is telling us we need for this trade because of risk, we need to do it as a long condor, or we think this one is going to be maybe trend up and it's going to be a good trend up, or it's going to trend down. So maybe we want to do a counter diagonal. All right, so these are all going to be in the course. We're going to go through each one of them and when and why would you do it, and then the setup. Okay, so that's going to be the big benefit of the course, having more time to go through. When is the best place or time to do the vertical, just a straight debit spread or butterfly or condor? All right, so here's some examples of ones that we've done. This was a long put debit spread, and this was shorting SPY, SPY. So instead of just selling naked calls or buying puts, we did this trade, at very low cost based on a put debit spread. So this gave us, very good defined risk, okay, totally defined risk, not naked on any option. Great for hedging, great to use for kind of a swing trade breakouts or up or down. So, maybe something one day up to 1 week or 2 weeks. Again, it could be 1 day up to 1 week. I'll show you this. I think this one we did was a 1-day trade actually. Got to lower your theta decay because you're short an option against your long. You're going to reduce your capital at risk. So that's going to give you returns of anywhere like a 1.5, so 150% up to 300% kind of returns or more that you can get on this. So here's one that we did here not too long ago. So this was going short SPY. The market was breaking down and it was trading at 549. And so this was sent out. It says new SPY retracement failure short. Okay, so it had gone up. This is one of the chart patterns. It went up to a certain resistance area and then it failed. Okay, it couldn't get through there. So it's a retracement failure. Okay, so that was the reasoning of this. Okay, so this could be a really fast move. So it tested that 50 daily moving average and it was looking for a downside break. So these could be a really quick breakdown. Okay, so this was showing everything was negative on our momentum, everything we look for. And then you want to have a profit target. I do that based on usually our standard deviation, any potential, moving average. This is what I call Fibonacci price target mapping. And then here was the spread. It said buy just a vertical debit spread here, buy in the 248, 243 put debit spread at around $1.35. And then that same day, we started at 549. Now it collapsed down to 539, and went ahead and sent out an alert to take it off because we had pretty much locked in our profit. So here was the trade. It was right here. So this trade is based on a price pattern. So here is where this was breaking down below. See how it came? Now it's breaking below the 21 here, and that green line is the 50 simple. So that's a big price point support. All right, so this is a breakdown momentum trade. So these things can be super fast, like just like a waterfall. So it broke that level here, and then look, just cratered down to that 540, 539. So we did this instead of just buying puts. You could have done that. We wanted to reduce our risk a little bit in theta, so we did this as a put debit spread. So we had a super low cost trade. And so here's the spread set up that we did. So this is what you'll learn in the course. And then this was also sent out to the alert service members. So this was it was traded at 549. So we bought a little bit out of the money. We bought the 548 put and then sold against it 543. Okay. So this was a $5 wide spread between the long and the short side. Look at our risk. Our risk here is $130. All right, so $1.30 is the debit cost, or $130, spread with 500, lesser cost. So potentially, if this trade moves and closes below our short strike of the spread, we're going to keep that max profit of $370. That would be a 284% return. All right, so this is also going to give us not total positive data, but very close. All right, so here's the trade, and you can see where we got in and what happened. This thing totally collapsed. And the same day on the 6th, it was trading when we set it up, it was at 549. And then later that day, it was trading at 539.89. So it's right here. Went ahead and just closed it out in case the next day it rips back up. So the spread went from 130 or $1.30 or $130 to 361. So here's your profit, 231 per spread. 177% return. So if you did one spread, you made 230. If you did 10, you made 2,300. All right. So then you can also see this had a positive theta right there of $16. So that's one that I like to use in a really fast momentum type breakdown or breakup. Now, the next one I want to show you is another one we do a lot of because this is great for certain conditions as well. So this is the wide wing butterfly. So we can control our risk by the wingspan of the butterfly or the wingspan basically of a condor. We can control our risk. So this can then, a wide wing provides us a wider profit zone than a narrow butterfly. We might do a really wide one, get a really big profit zone. This is a great strategy for really high volatility markets and high price stocks because we can reduce our risk so much. And also we can reduce if it's a high price stock, instead of playing a bunch per share, we can do this with the spread and make it a fraction of the cost. These are always structured for defined risk, great for hedging. We can leg in, leg out. They're what I call targeted trades. We just do these. We have a trade target, which will be based on standard deviation, price point breakouts, a lot of different things I look at, but it's a kind of a targeted trade and also great for what we call directional pinning trades, okay? So I'll show you a couple examples of that. That's when you've got a pin. So let's say you've got a $100 strike here and you think that at expiration, the price of XYZ is going to actually go out and expire at that 100 strike. Then that would be called that a pin at 100. All right, so this is where you can really take advantage of that implied volatility crush and theta crush that goes to zero. Okay, that's where you're getting the big returns. So great for high volatility markets. Trade duration can be 1 to 2 weeks out. No time decay. Returns, 2 to 1 up to 20 to 1. These things can be huge, and I'll show you an example of that. All right, so that's a really one that we use. Here's an example. This was a short trade using QQQ butterfly. So this was going to be $1,000, $10 West spread. So here was the short trade setup. It was trading right here when we set the trade up, right there at 303.14, right here. Let me see, right here. Right in here, okay, and then it broke. See, this is the area where we're looking for this break right here. See that? A lot of price action that breaks, and then it opens the door for the bigger move down. So this was the target. We were targeting this area here. Okay, we thought that was a really strong target. A lot of times we'll also look at option activity, option volumes and things like that at those strikes to see if they're telling us anything. So with this, we targeted them. We were targeting this 304 downside move price point. So we did this long the 314 put, okay? It was trading right here when we set the trade up. So long that 314 and then sold against it, $10 below it, the 304. That was our target based on our price target, based on the charts, etc. So we sold that, and then we sold the 304 294. Okay, so now we had this put butterfly, wide wing, long that put debit spread, short the bull put credit spread here. And we've reduced our risk down by selling the other side of the credit spread. Now we've got our total risk of $210, $2.10. So $10 wide butterfly, 1,000 less our cost, 210. So potentially, if this went out right there at the top of our tent, this would be a profit of 790. That's a 376% return. There's good profit in the wide butterfly zone. So that's kind of the setup, and then let me get this erased. And then here's what actually happened. So the entry was on the 23rd, expiration was the 26th, 3 days later. So you can see how this really started to accelerate. See that little black area? That's all that's left of the time component and the short time component, short volatility component in the spread. So there's still a little profit in there, but here was where we went ahead and closed it out. So here was on the 26th, it was trading at 306.17. All right. So when we set it up, it was trading up here at 314 or whatever. So now it's trading right there. Not quite perfect, but very close. So the spread went from 210. Now the spread was at 382. So that was a gain of $572 for one spread. Okay. So if you did one spread, it's equivalent to like 100 shares, you would pay $572, 272% return, versus if you just did the shares, you would have made 3.6. So just a really great for time decay volatility class defined risk, okay? So that's your butterfly wide wing. And then we can, control our risk. We can make it narrow wing, wide wing, just a lot of stuff we can do. And then here's a really great example of a penny trade that we did. This one was about as amazing a trade as I've seen. This was one that we did on Tesla. And we did this, these are all alert trades. So you can see, kind of the trades that have been sent out. So this one we were looking for an upside move, and this was based on option activity. And so sent this trade out. This was a super low risk trade, what we call kind of a lotto trade. It was trading at 189.35. So we said, new Tesla long, it's a binary monthly butterfly, which means we're going to risk the premium paid, and that's it. That's going to be a risk. So here, did this butterfly, the at risk was going to be $12, see, 12 cents. And so that was on the 8th, and then on the 16th was expiration, and this thing was trading, pinning right at our butterfly tent, 200 bucks. This trade was up $230 per spread. It was up then based on $12, it's 1,916% return. All right, so these are just crazy but exciting. All right, so this is what we call a pinning trade, and this was for this pin. So we set the trade up here, back here on the 8th, and we were looking for a lot of option activity, big resistance here, see the moving average, etc. So that was our target, 200. And then we targeted that with the butterfly, the body right there, 200. So we went out, it was trading at 189. So we went out of the money. We bought the 197.5, sold the 200, $2.5 wide. Then we sold the 200, bought the 2.5, 202.5. So we've got a $2.5 wide spread. Look at our cost, 12 cents. This spread, 12 cents or $12. If you did one spread, $12. If you did 10, you had 120 at risk. Now look at the potential profit. So the spread width is 250 less your cost. That's your debit cost. That's your risk. So if it pinned right there, that's $238. That's 1,983% return. So these are actually, you can see that, somebody says that, hey, I just made 1,900% return. People would say you're probably not lying. You're lying, right? But these are how the butterfly works. So here it was. Now we leg out of we kind of scale out, not leg out, but here it was, just right into going into the last few minutes of the day. So perfect pin right there at 200. So right at 200, this was up from 12 to 250. So this was up $238 right there at the end of the day, 1,983% return. All right, so we'll be scaling out, but we try to leave a little bit right for that last day to get potentially something like that. All right, and then here's a really good example. Here's a long call condor on Amazon. So, love these condors, because we reduce our risk, we have reduce our theta decay. And so this was a really good one for, for a kind of a breakout, but we have a certain range that we think it's going to hit. It's not going to exceed that. So we could have a wider profit zone in the butterfly, again, defined for very defined risk. Okay, really great for hedging because we may be long a call debit spread, we can just add a credit spread to it, or we may have a credit spread, we just add a debit spread and we can hedge quickly in and out. Great directional swing trade, wide profit zone, great for high volatility markets because we're reducing our risk big time. And trade duration typically, 1 to 3 weeks out, not much further than that. No theta, positive theta decay, and then 2 to 1 to 4 to 1 are kind of the reward to risk ratios that we typically would get. All right, here's one that we did not too long ago. This was on Amazon, okay? So just gonna show you how controlled this was. So new Amazon long was traded at 181.30, says daily cycle low retracement. So it came down here and it retracing off of a, it was retracing off a moving average. So set this out, and this was doing this condor right there. So the 182.5, 185, and then the 192.5, 195. So it looking like that. All right. And so then we did an adjustment. We widened the spread out. So we can do a lot of different things. But anyway, I won't spend much time. And then we ended up here on the 20th. Now it was trading at 190. Okay. So now we have the adjusted butterfly. We widened out the spreads here. So we're in like this, and we widen it further out to give us more room to the upside. Okay. So this one worked out great. We were up over 150 bucks, 106% return. Okay, on the trade. So you can see these returns are big because we've lowered our risk. So here's where we set the trade up right there on the 11th. And then we started getting a pop and a move here. We were targeting this area in this area here. This was a 786 retracement area. All right. So then it was trading out to 189.97. So here was the trade that we ended up in. We had this a different trade, and then we adjusted it to make it wider. So we ended up having the 182.5, 185 call debit spread on. All right. So we had that on. And then we had on the other side of that, so $2.50 wide spread there. And then we had, that was this side. And then we went out, and you can do these all at once or you can leg it. So then we sold the 195, 197.5 call credit spread right here. Okay. And that gives us what we call as a condor. So instead of just having the debit spread, we reduced our risk, reducing our theta. So we had this at potentially the 96 bucks was our max risk. So if we went out here or here, we did nothing else, we'd lose $96 per spread. But if it goes out inside our spreads here, this makes 154 bucks, which would be 160% return. All right, so great controlled risk trade for when we want to get that risk more defined. So here it went out right in the middle, and this was, right perfect where we wanted it. So it went from 181.30, now it's trading at 189.97, right in the middle of our spreads. So we're long that 182.5, 185 here, and then we sold way further out. We sold the credit spread here, 195, 197.5. So we had a big wide spread. Okay, so total risk of 96 bucks, max profit 250, $154 per spread, 160% return. So that is an example, and these are all spreads that I'll use, and we'll use, in the alert service or just in the trade room for the different market conditions. And then the last one that I like to use, we use a lot of these. So in the course next week, you're going to learn these, all these spreads, okay? And you're going to learn when to use them. So that's why the course is, about which option strategy to use, when and how. All right, so here's another one. This was a really great trade. Now, these are trades that I like to use for longer term movement. So if you think there's going to be a longer term movement, either up or down, we'll go with the calendar diagonal, either using calls for upside or puts for downside. So here's one that we did with Marvell. And so this is going to give us defined risk. We're selling time and volatility because we're selling that short end of this trade. Great for directional target trades, collecting income and getting paid while we wait on the direction to kick in. Trade duration can be 1 week out to months or years, okay? Great trade, I call it flexibility because we can do all kinds of adjustments and things, really cool stuff. Positive theta, no time decay. So here's one we did just recently. This was on Marvell, and we actually adjusted this into a different spread to increase the profit. But Marvell was trading at 73.65. So looking for it to break out. So send out this alert, set a cycle low, retracement reversal off the 200-day, the daily and the 4-hour, et cetera, had positive momentum. So went out and bought this calendar diagonal, starting out the 25 October, the 18 October, so 73.76. We did a couple adjustments, which I'll show you, and then we ended up profit taking on the 14th, 15th, and 25th. Okay, so anyway, those are the alerts text that were sent out just to show you that how detailed I go about these. So here was the trade setup. So this is what we call a volatility squeeze, and this had been consolidating for a long time. So got into this trade right here, and then did this counter diagonal thing. And well, if it still churns sideways a while, we'll do this kind of spread to get paid while we wait, kind of like a covered call, right? But we're going to go out further out in time to buy the long leg. Instead of buying shares, we're going to go out further in time, then we're going to sell against it closer in to take advantage of theta decay. All right, so this is a really great setup that we do. A lot of these, positive momentum, cycle reversal, all the things that I look for. All right, so then you'll learn this one at the course next week as well. And so then here is the first, this was when we did the adjustment. So we had the 73.65, then on the 14th, did an adjustment to make the spread better, widen it out. So now we were long the 73 call and short the October 81 call. Okay. So see down here, so we're further out in time, that 25 October, that's further out, long the 73, and then closer in short of the 18 October there. All right, so kind of long a call further out, short a call closer in. Kind of looks like a debit spread, but we're further out. So the spread setup, we set it up at originally at 3, I had to go back and look, but we had the spread set up at 395. Okay, so you can see here it's 11, 10, $8 wide spread. Okay, and we're in the spread for $395. So you can see the spread blew out and it was traded at 692, so we're up 297. But we did some adjustments to improve the trade. So the next thing we did was we adjusted this we were able to adjust it to a long call debit spread and really reduce our cost because of the profit we were taking in on the debit side. So on the 18th, now it's traded at 79.85. So we had the option expiration at the 25 October, still have plenty of time. So what we did was we're then long the 77 call, short that 85 call debit spread, $8 wide spread. And then the cost of the trade, what we ended up doing, we were able to adjust it to the 77.85 debit spread. Our cost, our max risk was $115. And so $8 less our cost there, $115. Potentially, if it went out above our debit spread side, we're going to make 685, 595% return. So that's what we're looking at, these adjustments. Anytime we can improve the trade, and that's how this one worked out, adjusting it from a calendar diagonal to the debit spread. So this just gives you kind of a synopsis of all the different ones. And then we ended up long that call, short the call here with an adjusted price of $1.15, flew to 631. Now we're up 516 on that risk of 115, 448% return. All right, so those are kind of a summary of the go-to ones that I like to look at. And then today, it's just kind of give you a start, kind of an overview of my favorite, option spread trades, the vehicles that I use for any market and condition. But, I was only kind of able to scratch the surface. So next weekend, that's when we're going to have the course, which will go into really great detail on the ones that I showed you today. So if you'd like to, make sure to put in that powercycletrading.com/special and then use that OP15 small cap to get that 15% off. So use OP15 here, okay? And then let's go through what we're gonna be talking about, take questions and go from there. Let's see, hold on, James. Let me get you something here. 1 second, bear with me. So then here's everything. You can kind of go through there while I'm getting something here set up. 1 second here. So you'll see the course is 197 today. It's 167. Now, so if you buy it, you may have some of these bonuses or all of them, but this is the price, 167, and then you just get everything on top of this if you're, when you buy this package. So you can, that's kind of how that works. So here you can use this link here. Let's see. You can use this link here, James. 1 second here. And we'll go through this and then take some questions and go from there. Let me just do something here. Okay, and then, all right, so use that powercycletrading.com/special. Let me give you that link again. Click on that and use OP15 on, whichever package that you want. Let me give you this link here. Make sure it works for you. Okay, I'm gonna click on that. Yep. Okay. Working good. Okay. All right. So then let's go through everything you're going to get and the course, what it'll cover and all that good stuff. So we're going to start this next weekend, the 16th on Saturday. And so you're going to get the course here today is $197, but you use that OP15, you're going to get it for $167. So 89% off. And then, you know, with the course, you're going to get, these are important things that'll help your trades in general. So you're going to get my cycle reversal indicator. These are the prices on the website. You're going to get my extreme range band indicator. And then you're going to get my option masters course that I did. This is more on the Greek, so you're going to get that as an additional bonus. Then you're going to get my Fibonacci price target mapping. This is how we set our price targets up or down, our defense targets. You'll get that. And then you'll get started trading options today. So this is a full option library you're going to get filled up. And then you'll get a 30-day trial membership to my trade club. You can start this when you want. We'll do a follow-up Q&A. We'll do that after the course on Tuesday. And then you'll get my option trading tutorial. This is a 60-page option guide with videos more on Delta, Gamma, and then a really good option strategy guide of 15 other different strategies. So, you know, all these bonuses, everything all put together, 3,600 today. Use that OP15. You get it for $167, 95% off. All that really great, valuable stuff there. All right, so that's course package 1. And then just click on it, put OP15. And yeah, the recording will be available. Yeah, everything will be recorded and broken down in 30-minute modules. So you won't, you know, you'll have the recording. And so you're going to get everything here that I just showed you, plus the live course and the recorded course. And so here's the package 2, if I can back up here 1 second. Okay, here's course package 2. Okay, now all it is you get everything in course package 1, but you're going to get my 5 alert service or trade setup alerts that I send out for the next 4 months. Plus, this gives you access to my trading club for the next 4 months. So all 5 of my trading alerts. Okay, so I may be sending out a butterfly or a condor, depends on the market condition. Might be doing a calendar diagonal. Might be an option pinning. We did this just last week on AMD, a pinning trade. It could be a breakout reversal, you know, like that SPY short, or it could be an earnings trade. So 5 different types of trades depending on the market. You'll get this for 4 months, and then with this you get my trading club for 4 months, which is the trade room you come into, or you know, Q&As, or everything there. And you can stop and start your membership when you want. So if you do go on vacation or something, you want to put it on pause for a day or 2 weeks or a month, you can do that, you know, to come back in and not waste your time there. All right, so that's what you're going to get. 4 months to my alert service, all 5 alerts. 4 months to my trading club. The cost of this is $597. Use that promo code today, 507. So great reduced discount. Typically, you send out 8 to 12 stocks or ETFs over the course of a month. Could be any of these types of trade setups, depending on the market cycle. This is what you're going to learn in the course. When would you use these particular types of you know, spread strategies? When I send it out, you get a trading guide, very, very specific trade setup video review. I do that after the close. Trades are then archived, so you can go back and look at them. Then we do a weekly Q&A every week. That's all live and recorded, so you'll have that for the next 4 months. Daily video newsletter, what the market's done after the close. I put out a video on that. And access to the trading room. So we have a virtual trading room open every day during the week from 9:30 Eastern to 10:30 or 8:30 to 9:30. Great place to come ask questions on any of your trades, see what we're doing. And then you get 6% discounts on everything on my website, any software or other courses. So really huge bonanza of bonuses here. So you can get everything here that you're seeing for 507. So here's just kind of going back through, you know, the success. We started this back in May of 2018, and through Friday, just a combination of all the different 5 different, you know, alerts together, basically 4 different ones actually. So we've had a total of 797 trades closed out. 574 winners, 52 break even, 171 losers. Run at a win rate of, high win rate of 79, about 79%. And these are unaudited, but kind of a summary of what you'll be looking at if you're interested in it. And then again, here's your, make sure you use that promo code OP15. You'll get the package one is $197, but today you'll get it $167. And if you want the alerts, you're just basically adding $400 to it. And today you're getting it for $507. So, you break that down, your alert service part of this with the trade club, you're getting a great deal on that. $400 is basically the addition to it. So, that divided by 30 days, you're basically $13. And, that's about $3 a day or so if you break it down that way. So, again, if you're unsure, you'll see on your tab here, option mastery. If you take it in the past, if you don't see that, then you didn't take it. And then, these bonuses you're going to get. All right. So you're going to get the option masters workshop. You're going to get my price target mapping. You're going to get my start trading options today, cycle reversal. All these are just bonuses, which are included free of charge. Okay. So the value of the course is $1,600, but today you get it for $167, and then you get everything, all those bonuses as well. So that's what you can expect there. And then here's nice compliment from Dennis. He says, just finished the Option Masters course, loved it. Hedging on demand is a game changer, allows one to enter trades with confidence. Already 2 of my probability trades, which were heading to my short strike, were converted to butterflies, which exited at a higher profit than the original trade. So he learned how to do the butterfly defense, and that really helped him on that trade. Slept much better, and the funds were reinvested. Compound interest is a little magic seldom mentioned. Okay, so here's what we're going to cover at the workshop starting next Saturday. So kind of an outline. We're going to get the foundation of the option trading. Okay, I'd like to start here so you understand the kind of the foundation core behind option trading. So we're going to go in a little bit more detail about how to use those option Greeks. Okay, how to use those to help your option pricing, understand how that works. So we're going to go through that in more detail at the course. We're going to go through how option pricing works. Okay, so once you understand how the option price works, then it's going to be easier for you to comprehend these spreads that you're going to learn in the course, and then which ones to use based on that. What is that market maker secret? How to use and take advantage of that, which we use for given a standard deviation to give us probabilities of price points being met. So very important to understand standard deviation. We'll go through that. That's kind of the fundamental part of part 1. All right. And then explain in layman terms so you'll understand. And then how can you just use option delta for your trade probability is really important. And then how, why, and when to take advantage of volatility and volatility skew. So I'll go through what that is and what to be looking for that. And then the option strategy guide. Hey, Sebosar, thanks for being here. And all right, so that's part 1 or step 1, and then step 2, which strategy to use. Okay, so this is where we're going to go through the rules that I look for. So for helping me select what option strategy to place for a specific market cycle, up, down, or sideways, for specific based on the chart pattern. I use that as a condition. And then based on the market condition, are we in a high uncertainty, low extreme? Okay, so we're quantifying the market. And then how far out do we want the trade? 1 day, 2 weeks, 3 weeks. So these are things that we're going to go through on how to establish your trade, which option spread to use based on these kind of 4 conditions. And then step 3, we're going to go through the process for selecting which strategy to use and when. So for your selling, options, what are the best strategies to use and when? Best for option buying, what are they, how to use? Using that option butterfly, how it is just seriously amazing for selling time and hedging, and then how to use the, get returns of 100,000% return using the butterfly. That's the one that we go for just specific situations. So you'll learn that in the course. And so, then just other things we're going to cover. So it's a very extensive course. The major trading advantage is long option condor, very, very important. So that's one of our favorites. And then how, why, and when to use that long condor. Okay, when and how to use the counter diagonal, medium to kind of longer term. So we can set these up for 1 or 2 weeks out, all the way we can use leaps and set these up 2 or 3 years out. So we'll talk about and go through that. Then how does the calendar diagonal work to create that market neutral and directional defined risk trade for income getting paid while you wait? Very important trade strategy to use. And then how this strategy works based on capturing that time decay without completely sacrificing direction. And then how to structure it to profit from the difference in implied volatility between the short and the long. That's what we call the skew. And then how, why, and when. So there's a lot that we're going to cover here. And again, it's live, but it's recorded. So, if you can't make it, or you obviously go back and over and over, to help you learn. And then step 4, part of it is your favorite strategy we're going to go to. We're going to, really go through in great detail, just buying options. If you just when you just want to buy calls or puts, kind of what we're looking for there. The vertical debit spread, calls or puts, the butterfly condor, and the calendar diagonal. So these are kind of the go-to strategies we're going to focus on. You're going to learn in the course, step by step. When would you use it? When would you not? And then how to structure it, how far out in time, et cetera, those kind of things. So then how, why, and when to hedge, okay? And then what is the, progression of hedging using options? You're going to get that. If you have a long stock, calls, et cetera, we're going to go through progression of hedging. Trade and risk management, how to do adjustments. We're going to cover that. We do a lot of adjustments sometimes. And then the matching vertical spreads for hedging, okay? How to adjust to a free trade. We're going to look at a lot of examples and situations where we've taken a trade where we've amortized it or adjusted it to make it a trade with zero risk. And then you'll get, what is assignment risk, expiration, auto exercise. So a lot that you're going to get and learn with this course. Okay, and then here's the enrollment bonuses. Again, use that powercycletrading.com, click on that and use OP15. So first off, you're going to get my cycle reversal indicator. All right, so this is a really great tool we use for about every trade. So it's based on a percentage range momentum indicator. It's got an upper and lower study. So you're going to get this. Got it for Thinkorswim, TradeStation, TradingView. So this helps us to establish what the cycle is. Are we getting a cycle reversal up or a cycle reversal down? So this helps us on cycles. So you're going to get that as a bonus tool that's going to be super helpful. And then you can see here's getting a cycle reversal. Anyway, we're going to go through how that's used. You'll set that up. And then here's a really another great indicator tool you'll get is my extreme range band indicator. This shows us, it identifies when we're getting to price extremes up or down. So when markets can start getting exhausted up or down, and that's where we look for reversals in our trade setups that you'll learn these different option strategies, okay? For maybe reversal down or up, which strategy would be the best. So this is an alert signal to signal when we're getting buying or selling exhaustion, which becomes the first signal that a security is starting to reverse. So very accurate. We use this a lot as well. So you can see here it got really stretched on QQQ up here, then got a reversal pullback. Anyway, we'll go through this indicator, will be part of the course that you'll get that to use. You can see how this is just kind of nailing the cycles here. Here was one up here, so it gets up here to that really extreme range band there. Reversal here, pulls back. Here it's a reversal, pulls up, pulls down, so you're going to get that tool, which is super helpful. And then you're going to get bonus special 3, you're going to get my Option Masters Workshop. This is a 6-hour course on options. This is more geared towards the Greeks, okay? So it's a really good complement to the option strategy course. So this is more in depth on the Greeks, greater focus on the Greeks, so you'll get that. And then here's we do this for every trade that we put on. So this is what I call price target mapping. And this is a course that you'll get this, and this incorporates using Fibonacci, but also Fibonacci analysis, trend line analysis, price action, standard deviation, and option activity. So 3-hour plus course on that. You'll get that. This will really help your trading, being able to, define targets. And then you're going to get another option course, my Start Trading Options Today. So this is kind of intermediate for beginners, or a little bit more intermediate. So you're going to get what are the benefits of options versus stocks, must know option basics, mastery puts and calls, how option expiration works. So we're going to go through in this course, you get the beginner's kind of strategy, how to use a covered call, how to use a protective collar hedge kind of strategy, and then the debit spread. So another just great complement, put in your trading library for options. So you'll get that. And then you'll get, if you do the package 1, you get 30-day trial membership to my trading club. If you do the alert service, you get this for 4 months. So I have virtual trading room every morning from 9:30 to 10:30 Eastern, and then Monday through Friday. So if you've got a trade you want to look at, or have me look at, or see what we're doing, come on in. Do a daily video newsletter update every day after the close, what the markets are doing, what we're doing. Trades are archived. Then we do a weekly Q&A, live and recorded. You get a trader's educational vault with the club membership, and discounts of 60% off on any course or software on the website. And so I always like to refer to this one from Jay, one of my old members, said reading books is fine, but seeing the actual option trade setup makes a huge difference. Thanks, Jay. So that's going to be a big plus for you. So you get that. Then if you want to stay in, we have other packages, but you get this 30 days. And if you do the alert service, you get it for 4 months. And then we'll do a follow-up Q&A. Okay, so this will be on Tuesday typically. And then, come in the trading room, ask questions. And then another bonus, you'll get my option trading tutorial. So this is a 60-page guide with videos really covering the Greeks, delta, gamma, theta, option pricing, standard deviation. So more on that. And then the last nice bonus, 15 option strategy guides. So if you've ever wondered, okay, what is a back ratio spread, or what's a ladder spread, so this is going to go through and show you 15 other trade constructions and when to use. So this is all, a very, very auction geared course that I'll start next week. And those are kind of all the things that are covered. And then here's just a little bit more on the alert service, and then any other questions, let me know. So here's from Waleed, one of my members said, I have to mention one thing. I'm subscribed to a lot of services who send out trade alerts. Some are good, others are not that great. But one thing I would like people on this webinar to know, when I get an alert from Larry, I do it blindly, as time has shown me that this man is dead accurate in his recommendations. And then here was another nice compliment from Dan. He said, you're very diligent, totally thorough with your analysis. That is the foundation of the success of your alerts. I paid for my subscription with the first 4 trades I took when I was learning how to trade options. So please feel free to share with participants, okay? So again, you get, if you do the alert service, you're going to get everything in course package 1, but you're going to get all my alert, all 5 different ones for the next 4 months, and then you can renew if you want. So for today, 507, 15% off. And when I send out an alert, try to make it as very defined as I can. So I'll send out a suggested option trade. Now, a lot of the members just want the trade, so they'll just do their own thing. They may just buy shares, calls, or puts, or whatever. But I'll also always send out an option spread trade, okay? So within that, you'll have the entry level that I'm looking for, profit targets based on, Fibonacci price target mapping, what option series you should use, stop loss guidelines, and then I'm constantly monitoring these trades throughout the day. So if anything needs to be done, I send out a text alert on that. Any adjustments or just updating where it is. Trades are listed and archived. All right, so that's basically what you're going to get there. Then I do, after the close, if we did a alert trade, I'll send out a video update, what it was done, why it was done, the reasons for it. You get the daily video newsletter then for every day for the next 4 months, weekly Q&A, access to that virtual trading room, which is the big ticket plus right here. So open from 9:30 to 10:30 Eastern every day. And then discounts on anything on my website, either any other courses or software, and Trader's Education Vault. So that is, what you get there. So here's some update here on, these are the counter diagonals that we do quite a few of. These are from June the 19th through yesterday. We've had 305 trades close out. These will be either calendar or calendar diagonal alerts. 221 winning trades, 17 break even, 61 losers. We're at about a 78% win rate. All right, again, unaudited, but kind of summary of those. And so here's one that we did not too long ago. This was on Marvell. I think I showed you this earlier, so I won't go through too much on that. So that was Marvell. Here's another one. This was a put counter diagonal on Conoco for a short trade down. So you see it says new Conoco retracement failure short, and put this spread on at $1.65. Anyway, so here's just kind of a summation of, when it was put on, some adjustments here, and then profit take, et cetera. So this was, started at 109.85. You can see here now it's at 103.59. This was up $357. So this was a alert trade for a downside move. So beautiful trade. When you look back at this, look at that channel. So we got in right here and just channeled down, and then we got out right there. So it went from 109.85 down to 106, 103. And this was working a put counter diagonal for a longer term move. So we set this up after adjusting it. We had a lot of profit that we baked in or booked in. So we had adjusted this down to actually a credit from rolling the long spread down, collecting all that profit. So we ended up adjusting this to the 20 September 106 put long, short the 13 September 101. And we had adjusted price of a credit of 77 because we booked so much profit on the original put that we were long. And then we took it off. The last part was on the 13th. Trade at 103.50 is up 412 on zero risk on that trade. All right, so that's ConocoPhillips. Here are a couple other examples. The butterflies that showed you earlier, we do a lot of these as well. We've had since inception on these with 2019 through yesterday, 193 closed out, 138 winners, 13 break even, 42 losers, 78% win rate. You get returns of 1 to 1 up to 25 to 1. These are huge potential profit makers. Yeah, but we use them only selectively at certain periods of time, and that's what you're going to learn in the course when to use this kind of trade setup. So here was one on Amazon. This was a wide wing butterfly, $500 wide. So we set this up. This was not too long ago. So we did this. It was traded at 186.95. Daily cycle low retracement reversal off the 150 period moving average. So we set this one up as a butterfly right here. So here was the butterfly, the 185, 190, 195 at around $1.65. Then on the 18th, where it was trading, now it was traded at 190.15, et cetera. So these are constantly updating you of anything you need to know. And here was that trade. So set that trade up here, right there on the 15th. And then it was traded on the 18th, right there into our target, 190. So this was our price target, hitting our price target there at 190. So it went from, the entry up there to right in that area. So we did the 185, 190, 195, $5 wide, total risk, $1.63, spread width 500, potential return 337. If it went out at that pin, but anywhere in between, we're still going to make a great return. So here it went out pretty close. It was right here trading right there at 190.02. That was pretty darn close. Targeting 190, went out trading at 109.02 right there. So this went from 163 up to 453. So this was up 290 per spread, 178% return. So that is one that we had not too long ago there. And NVIDIA long haul condor. Here's another one on NVIDIA that we did not long ago. This was for an upside move, and this was trading NVIDIA using a long haul condor. So we got into the trade right there. And then we had this break to the upside. We were targeting right there. So that trend line coming in. Right there was our target. So it went from 121 up to 125. And so we did this as a call condor. Okay, so keeping our risk super low, getting our theta down. So we bought the 121, 125, sold the 127, 131. So we had this spread on like that. Big area of room in there for potential, and this cost us $107. That's our risk. Spread width $400 less 107 goes out inside here. We make 293 bucks on that risk of 107, 273% return plus positive theta. So a really super trade setup, and here it went out right about there. Got out of it, right in here. And so this went from 107, now it's trading at 230. So it's up $123 or 114% return with a lot of room in there. So we got out there, I can't remember exactly what was going on. The market was probably going up and down quite a bit. So that was NVIDIA. And then here's one more that we did. This was another kind of a lotto trade like I showed you earlier on Tesla, but this is one that we did not long ago on GLD, the gold. Okay, so this was in August. We did this pending trade, and this turned out really good as well. So we set this up. Originally, we were targeting 225, and then we saw the next level up 230. So I won't, go through. I'll go through it pretty quick. So we set it up at 24 cents, and then we did an adjustment, which you'll see. So we had the cost. Our cost in this trade was about $29. And so here is on the 16th expiration. Now it was trading at, we went into the trade, it was trading at 222.85. And then here it was at expiration, was trading at 230.50. So we were up over $200 a spread for a 689% return on that trade set out. So this is right here where it's set up right there. Had a big move up and boom, out there, okay? So went out with a profit of $203 per spread, 700% return. All right, so here's the spread, 127, 230, 233 on that spread right there. Cost of the trade, we ended up having the adjusted cost here of 29 cents or $29. Spread with 300 less 29. Potential to make 271 or 934. We didn't get it exactly at the penny, but came pretty close right here. So the trade was up right there. It was up, trading at 230 right there. It was up $202. Went from 29 bucks to 232. So not bad. So that was another example there. And that's pretty much everything. We've got one on for AMD. I'll show you for a binary pinning trade for next Friday. We'll see how that goes. Any questions? Here I'll show you the one that we did on Friday. I think this was Friday. Let's see. We did super low risk trade. Let me pull it up. 1 second. Yeah, I used that link there that I showed you, powercycletrading.com/special. Okay, and then you'll get everything here, and you'll get it for 167. Just make sure you use OP15, and yeah, the course starts next Saturday, and everything will be recorded. So let me show you. So here's AMD. Now what we did was we're targeting this 155. There's really a lot of option activity there. And then you see this area of kind of resistance. So that's a really good target area. And this is, based on monthly option expiration, which is next Friday the 15th. All right, so we're seeing good activity here. You can see here, this is the 50 simple moving average. And that yellow is 150. So that's a big target zone in there just from this moving average. And then on the if you go in and look at the option chain, there's huge volume trading at the 155. So based on we're getting a cycle reversal momentum, we're looking at targeting 155. Now, this thing could just roll back over and go down, but the thing is we've got this set up for the risk of 23 bucks or 25, depends on your entry. But so we ended up with this butterfly at $23, okay? And this is for expiration next Friday. So we're into this butterfly, the 152.5, 155, we're targeting 155, 157.5, there's the butterfly, 23 bucks. All right, so that's the total risk, you know, it's $2.5 wide spread. And so, you know, that's what we call it, why we call it a binary, because we have that risk of only $23. And so that makes for a potentially great return. You know, this thing could return a big return if it goes out here. That's going to be, what is that, 250 less 23? Potential to make $227. And we've had them pin, but if it goes out anywhere in here, it's still great. So potential $227 on your risk of 23. 986% potential return on that. All right, so that's we'll see how that goes. And anyway, any last questions here? Just make sure that you take advantage of that special link here, and then use OP15, and then you're good to go. And I'll see you everybody back Monday, or I'll see you at the course. Let me make sure you've got that link one more time, and then any other questions, make sure to ask. So again, use that Power Cycle Trading /special, and we give that to you. And then OP15. Okay, use that, and then pick out whichever package you want, and then use OP15. All right. Hey, thanks, Sherry. All right, so that's everything here. 167 today. If you want it with the alerts, 507 today. And I'll see everybody here Monday back in the room, or I'll see you next Saturday, November the 16th. So here's just one last look here. Where did it go? Here it is. All right, there you go. All right, again, everybody, thank you so much for being here. Thanks, Roger. Thanks, April, Sherry. Thanks, Avasar. Cheers, everybody. Ciao.